Let's bring in our first guest. We've got Michael Harkins. He is the president of Levy Harkins and Company, here to give us a look at value investing and the world of positive non-interventionism. More on that in just a moment. Michael Harkins, always a pleasure. Thank you for joining us.
Thank you, Pimm.
Tell us first about the consumer confidence number coming out today. 64.5. And that's reason for cheering these days.
Almost joy, actually, this morning at 10 o'clock, which is rather entertaining because it's a crummy number. And any other of the years in the post-war years, they've been putting this index together since 1967, and we would have said, yuck. I mean, 64 is really poor. It would have been about the fifth worst number ever prior to 2009. And then confidence fell off a cliff and got rather twice as awful as it had ever been before. There was a single month in December of 1974 when we were gloomy, but never as gloomy as we were in February, March, and April of 2.5 years ago.
So is this a situation where, we've been down so long that anything looks up from here?
Yeah, pretty much. I mean, this is a ray of hope, which would have been considered the depths of despair 5 years ago. This index regularly trades over 100, so 64 tells you just how bad it is. And it's quite a sophisticated index in that it asks consumers, what's your likelihood of buying a house, a car, a major appliance, going on vacation? It's an all-encompassing index, and my goodness, America has been pessimistic these last 3 years.
Or does that mean that investors should be pessimistic?
No, quite the obverse. It works the other way around. 1974, in the fall of that year, was a marvelous, a once-in-a-century time to buy stocks. The bottom was made while this index, in March of 2009, was so very, very bleak, dark. And now, we're feeling a little better, just slightly better.
All right, well, so if we're feeling slightly better, and investors should do the opposite of what people are telling us from the consumer confidence numbers, how, as an investor, do you maintain your confidence to make these decisions at a time when everyone else around you, as witnessed by the consumer confidence numbers, is bleak?
Well, as Jim Grant would tell you, you either get great values or good news. You don't get them stapled together. That never happens. And it's far safer to go for great values, because when you wait around for confidence to return, if the news turns bleak again and the values aren't so great, you lose a lot of money, and there's no receipt. There's no department of confidence that you can go to and say, I waited to confidence to return, now give me my money back. It doesn't work that way.
All right, so if it doesn't work that way, what are some of the telltale signs of value right now in the market?
Well, yields are good. You can buy quite a number of big multinational, but based in America companies that have got 2.5% and 3% yields that go up every year.
Okay, something better than the U.S. 10-year Treasury, right? We just said that was 2%, so you want something that's going to be paying you more than 2%.
And also goes up through time, can be inflation adjusted. I mean, we own shares in Medtronic, the original heart pacemaker company. It yields about 2.5%. It's not paying out a big proportion of its earnings, so it will continue to grow. And it's very hard to put off getting a pacemaker implanted. By the way, the economy has been so bad that people have been turning what you would have thought in the past was necessary surgeries into elective surgeries.
Right, essential becomes elective.
Yeah, that's been hard to believe, but yes, that's how bad things have gotten.
All right, so you're looking for payouts in companies. All right, so something more than 2%. You mentioned Medtronic. What about cash flow? Are you looking at cash flow as a metric?
Well, cash flow is always our yardstick.
Okay.
It has been the mantra of Levy Harkins since we began. So you want to do this only with companies that are not increasing their debt, have modest buyback programs, and have the cash on hand to do it. And most importantly, the payout ratio is not egregious. You can have growth in the future. Medtronic makes all those marks because it's only paying out about 30% of its earnings.
Now, you mentioned that this was a hallmark of what you do at Levy Harkins. How long have you been in this business, and have you seen markets like this before?
Over 30 years, I'm sorry to say, and no, none of us. I take any piece of research that says usually or typically in circumstances like this, and it sees the trash pail the instant I read that for the second time. There are no hallmarks to go by except the Great Depression, and monetary policy has been so different from what happened in 1929 to 1932. I mean, just last week, the Europeans printed 490 trillion euros. To give you a feel for that, in January 1st of 2008, the entire Federal Reserve Board had $800 billion in footings. Mario Draghi did almost as big as that in 1 week. It took the Fed from 1913 until 2008 to get to $800 billion.
Would that generally be good for stock prices? I mean, because won't that inflate asset values, at least on a nominal level?
Careful about the word generally. It
Yeah,
sounds an awful lot like typically.
Adverbs floating around.
It sounds just like typically and usually. This is so different that I'm not sure. But I'd much rather bet that way than not. And inflation is always on our minds. And the chance of hyperinflation is not zero. It's not a kurtosis event anymore. It's a real probability.
A real probability. So you want to be with companies that know how to deal with these kinds of situations.
Exactly right.
A market of stocks, not a stock market.
Yes, and I'd rather be in stocks than bonds. The risks in bonds seems lunatic to me.
Michael, I want to ask you about Sir Philip Haddon Cave. You and I have spoken about this gentleman previously. Who was he, and how does the phrase positive non-interventionism apply to his role in the Hong Kong government and economy?
He was first Deputy Financial Secretary, then Financial Secretary, and finally Chief Secretary of Hong Kong from the late 1960s until 1985. And he invented the policy of positive non-interventionism, which was a bit of a euphemism, and I used to tease him about this. He wasn't a very teasable man at all. And I used to say to Sir Philip, isn't that just laissez-faire capitalism with a great aphorism stapled to it? And he would patiently say to me, no, and then there'd be a sly smile. I bring up Sir Philip because the answer to Europe's problems cannot be more Europe. Not more Brussels, not more intervention, not more stopping businesses from going forward, and certainly not more money, because the German public won't put up with it. But they can look east to Hong Kong and say, how did this sleepy backwater that had nothing going for it in the late 1960s become this spectacular spot today? And Sir Philip came up with the notion that government should keep order in the streets, government should make sure that contracts are enforced, and then government shouldn't do another damn thing. That was it. He even forbade the keeping of economic statistics in the colony because he was afraid that if somebody found out how the economy was doing, some level of government would try to do something about it. He was great friends with Sir Keith Joseph, who was Margaret Thatcher's ideas man. He was great friends with Milton Friedman, and they would regularly exchange ideas coming out to Hong Kong. They took all of the regulatory apparatus off this backwater barren rock, and it worked like a charm. Today in Greece, if you want to go start a business, it's impossible. It's like the old India, where it was a Raj kingdom and you could never get a permit. And the same thing is almost true in Italy and Spain, and certainly you can't pay the egregious taxes, so tax evasion is rampant. Well, Hong Kong is the idea set forward. We need less Europe, we need less intervention, and by the way, this is not ideological. If you think about it for a second, it was Jimmy Carter who gave us Fred Kahn, my old economics professor at Cornell, who invented airline deregulation and then an awful lot of deregulation after that. And it was Bill Clinton who said the era of big government is over in his State of the Union address in 1996, and it worked like a charm. We had prosperity, we had budget surpluses. It's not hopeless. If government simply does less and gets out of the way, we can do much better.
All right, but having said that, do you see that happening in Europe right now?
No, sadly I don't. I see it in China all the time. They kept the policy of non-interventionism long after Sir Philip was gone. He left in 1986. And it says something about the man, by the way, that he never went back. So he never made a dime out of his public service. But they kept the policy in 2006. So when you look at China today, what you're looking at is what happened when Deng Xiaoping took over, looked across the Kowloon Strait and said, that idea set works better than Maoism. Let's go pick that.
So why aren't the Europeans at least borrowing some of those ideas right now? Because it seems as though all of the work that they're doing is moving in exactly the opposite direction.
I know. I do look to sound like I'm screaming at a train that's going at huge speed that way to tell it to go the other way. Yes, I do sound like that, I know. But the answer can't be more Europe. The bond markets won't finance it. Draghi can't keep producing more money. And the silver lining in this is that Europe is doing so many things so badly that if they just stop doing quite so badly, it would be a big improvement.
So they would just become average in certain aspects.
If they became average, it would be marvelous.
Do you think that that's likely, let's say, in the next 6 months? You see any of these moves really being implemented? Because it seems as though you're just getting more and more regulation and more power coming from the central government, particularly in Brussels.
Yes, and the European populace won't put up with this. You know, you lived in England. They want their high-fat emulsified offal tubes. They don't want to be told they can't have bangers and mash in the morning from somebody in Brussels. It just won't translate anymore. So there can't be more Europe. And the answer is there has to be less.
Well, let me ask you then, does this mean that you're looking for some possible investments in Europe, or is this still off is not on the Levy Harkins menu?
Not yet, because I'd have to see the train at least start slowing down before I can think it will go in the other direction. I don't mean to sound like a crank here, but it is the way to go forward. And we have been going the wrong way for a very long time and way too fast.
Got to stop the train before you can reverse direction.
You got to stop before you can go the other way around.
All right, so let's talk about some other investments. I know you mentioned Medtronic. Tell me about some others you've mentioned before. Qualcomm and Tupperware. You still like them?
Well, Tupperware I like because it gets a rise out of you.
Right.
It doesn't seem like it can be a good investment, and it has been because it has such marvelous cash flow. But Qualcomm has got to be the cash flow champion of our age, in that every single cell phone with CDMA technology in it, which is to say every smartphone in the world, pays Qualcomm a royalty of 3.5% or so. The agreements are a little different. And that means they don't have to make a bet on whether it's Google that wins or Apple that wins, or does Samsung come back, does Nokia come back from the dead. Doesn't matter. They all pay a company out in San Diego 3.5%, and it comes in cash. All you need to do is open the envelope. It's a remarkable place to be, and they'll be in this position with these patents for many, many years.
You used the word bet, and I want to just explore that a little bit more. This idea that people, in making certain investments, don't have to bet on a particular outcome. Is that part of the value investors' philosophy, that you buy something at such a discount that you're not betting on having one thing go right in order to realize the profits?
The strangest thing about investing is that the one thing you can really know, and the only thing you can know, is the price you pay. Everything else is, in that dark area, of uncertainty. But if you can know that you're paying, something like a cash-adjusted 10 times earnings for Qualcomm. By cash-adjusted, I mean they have about $13.50 a share in cash, and the stock is about 54, and it will earn a little less than $4. Those are knowable things. Everything else going out into the future is really unknowable. Economic events, inflation, all of it. But this you can know. And if that's attractive, and it looks much better than a 10-year Treasury note, pay attention to that. That's where the value is, and that's how investing success manifests itself.
Put you on the spot. Worst investment idea, let's say in the past 12 to 18 months?
We own warrants in Bank of America. Thank heavens we do not own the stock. I did not have the heart to own the stock. When Ken Lewis left, he left in a huff, and I think the country treated him badly. And he thought Bank of America would earn $30 billion sometime soon. The total market cap right now is $50 billion. It is really cheap if the world doesn't end, but I should never have bought these warrants.
I want to thank you very much, as always. Michael Harkins joining us, Levy Harkins. Thanks so much for enlightening us as to positive non-interventionism as well.
Thank you,
Appreciate it. Happy New Year.